Hello, everyone. Good morning, good evening, good afternoon, whoever is watching this at any point of time. I'm wishing you all. I'm Reshma Jain here. I'm a chartered accountant and I'm going to take financial management for CA Intermediate, the chapter leverages. Okay.
Okay. To know the leverage, to know this chapter, first we need to know what is profitability statement. Starting with sales, starting with sales, what do we reduce? We reduce our variable cost. Variable costs are like wages, materials. If we reduce this variable overheads, we get contribution. These contribution are contribution towards the fixed cost. How much we are contributing towards the fixed cost. So sales minus variable cost will give us contribution. Contribution is after subtracting variable cost, how much are we contributing to the fixed cost. After fixed cost we subtracted, we get EBIT or operating profit. After this we subtract interest. Here it is EBIT means interest before interest and tax. We have still not subtracted interest and tax. When we subtract interest we get EBT, earnings before tax, less tax, we get profit after tax. After this, if there is a preference dividend, we need to pay the preference dividend, and what we get after that is net earnings available to equity shareholders. This net earnings available to equity shareholders when divided by number of equity shares will give us EPS. So this profitability statements we need to be thorough to understand the concept of leverage. Okay. Now what is leverage? Okay. Leverage means power or influence. The influence of one financial variable over some other related financial variable. The influence of one financial variable over the other financial variable. So what we are going to see, one financial variable, how it is affecting the other financial variables. So we are going to see that. Okay. For that, before we need to know what is business risk and financial risk. Business risk are day-to-day risk. This risk associated with firm's operations. It is uncertainty regarding future EBIT. What is financial risk? Additional risk on shareholders because of use of debt is called financial risk. Now, keeping in mind, we have types of leverages. One is operating leverage, one is financial leverage, and one is combined leverage. Operating leverage measures the business risk, financial leverage measures the financial risk, and combined leverage measures the total risk. How do we measure business risk through operating leverage? Is we are going to see the relationship between sales and EBIT. For financial leverage, we are going to see the relationship between EBIT and EPS. And for combined leverage, because it is a multiplication of operating leverage and financial leverage, we are going to see the relationship between sales and EPS. Okay. Taking an example where there are 10 units and 20 units. Sales at rupees 10 per unit, we have the sales 100 rupees, 200 rupees. Variable cost at 5 per unit, we have variable cost 50 rupees and 100 rupees. So contribution is 50 and 100. Less fixed cost is 10 and 10, which is equal to 40 and 90. With this small example, we'll understand what is operating leverage. Now, the sales has increased by 100%. The variable cost has also proportionately increased by 100%. Contribution has also increased by 100%. But the fixed cost has not changed. The EBIT has disproportionately increased by 125%. So this disproportionate change in level of EBIT due to change in sales volume because the fixed cost does not change is called operating leverage. What is operating leverage? It means tendency of operating income to change disproportionately with the change in sales volume. This is due to, why is it? Because operating fixed cost which does not change with the change in sales volume, because it is not changing, our fixed cost is not changing, we have a disproportionate change in EBIT. In other words, what is operating leverage is, we have employed fixed assets, which will generate sales. Why are we employing fixed assets? We'll have benefit sales, we'll have cost of fixed cost and variable cost. So because of sales there will be variable cost, so our fixed asset should generate enough revenue so that it covers our fixed cost and variable cost. This using of fixed asset is called leverage. So our operating leverage is a function of three factors: amount of fixed cost, variable contribution margin, and volume of sales. How it is measured? Percentage change in EBIT divided by percentage change in sales, or contribution divided by EBIT. So we can understand through EBIT change was 125% in our example, percentage change in sales was 100%. So we have degree of operating leverage 1.25. Our contribution was how much? Our contribution was 50. Our EBIT was 40. So here also we have 1.25 degree of operating leverage. Now break even analysis and operating leverage. What is break even analysis and operating leverage? What is break even point? Break even point is a case where there is no profit, no loss. No profit, no loss. When there will be no profit, no loss? When our contribution covers our fixed cost. When our contribution covers our fixed cost. So how we will get break even point in units? Fixed cost divided by contribution per unit. So our break even points, suppose our fixed cost in this case is ₹10. What is contribution per unit? 50 divided by 10, which is equal to ₹5. So our break even units is 2 units to cover our fixed cost. So what do we understand from this is, at break even point there will be no profit, no loss, because our contribution covers our fixed cost. So if the sales were 2 units at ₹10, our sales were 20, our variable cost would have been 10, our contribution would have been 10, our fixed cost would have been 10, our EBIT would have been 0. So this is the case of no profit, no loss. How do we compare it with leverage? Okay. See, you know that higher the fixed cost, there will be higher operating leverage. Lower the fixed cost, there will be lower operating leverage. Because fixed cost is something which is responsible for the operating leverage, because it does not change, which affects disproportionate change in the two financial variables. Now, when there is high operating leverage, when there is high fixed cost, there will be higher BEP. Lower fixed cost will be lower BEP. So, can we say higher operating leverage means higher BEP, lower operating leverage means lower BEP? Okay. Now we'll take up the concept of margin of safety. What is margin of safety? That is extra sales apart from the break even sales. The percentage of extra sales comparison to break even sales. So sales minus break even sales divided by sales into 100 is called margin of safety. It is also measured as EBIT divided by contribution. The current EBIT divided by contribution is called margin of safety. whereas degree of operating leverage is contribution divided by EBIT. So our degree of operating leverage, can we say from this 1 and 2, 1 and 2, that degree of operating leverage is 1 by margin of safety, which is they both are inversely related. So if the margin of safety rises, the business risk will fall, because definitely if the margin of safety is more, our risk would be lower and operating leverage will also be lower. If margin of safety falls, business risk would rise and degree of operating leverage will also rise. Okay. When do we have a positive degree of operating leverage and negative degree of operating leverage? We have positive degree of operating leverage when the firm is operating at a level higher than break even level, which means we have some profit, we have positive EBIT, we have a positive operating leverage. If the firm is operating at lower than break even point, our EBIT will be negative, so we'll have a degree of operating leverage as negative. So what can we infer from that? If we have a positive operating leverage, our firm is operating at level higher than break even level, and if you have a negative operating leverage, our firm is operating at level lesser than break even level. We'll see a case where there is no fixed cost. If there is no fixed cost at all, our degree of operating leverage will be 1. How is it so? Taking the same example, here if the fixed cost is nil, contribution is 50 and 100, fixed cost is nil, our EBIT will be 50 and 100. So the percentage change is 100% only. There is no disproportionate change because the fixed cost is nil. So percentage change in EBIT divided percentage change in sales would be nil, would be same. So the degree of operating leverage will be 1. Now positive leverage means operating at greater than break even point. Okay, we'll take situation 3 where contribution equals to fixed cost. EBIT is 0. It means operating at break even point. What will be our degree of operating leverage? Contribution divided by EBIT, which is 0, which is undefined. So with all these analysis, can we say if our operating leverage is negative, is operating at lower than BP, EBIT will be negative. If it is infinite, operating leverage is infinite, it is operating at BP and EBIT is 0. If it is positive, it means operating at higher level than BP and our EBIT is positive. Degree of operating leverage can be never be between 0 and 1. It can be 0 or less or 1 or more. Next is financial leverage. What is financial leverage? Okay, we had EBIT as 40 and 90 in our example. Suppose we have an interest of say 10 rupees. This change was 125%, correct? We have an interest of 10 rupees. What will be our EBT? Our EBT will be 30 rupees and 80 rupees. Here there is no change. What is the change in EBT? 80 minus 30 divided by 30 into 100. It is 166%. So there is a disproportionate change in EBT due to change in EBIT. This disproportionate change is called financial leverage, the ability of a firm to use fixed financial charges to magnify the effect of change in EBIT on EPS. Suppose if we have EBT and EBT is 30 and 80. If the tax is at 10%, we have 3 and 8 rupees. So it is 27 and 72. How much is this change in EBT? 166%. Change in tax is also 166%. What is the change in profit after tax? 72 minus 27 divided by 27 into 100, 166 percentage. So our percentage change in EBT, tax and EAT remains, PAT remains the same. But our EBIT and EBT percentage differs due to fixed financial charges. So this relation is called financial leverage. This is measured by EBIT divided by EBT, which is profit or before tax or earnings before tax. How do we measure degree of financial leverage? Percentage change in EPS or percentage change in PAT or percentage change in EBT, all will be the same, divided by percentage change in EBIT. Situation 1. When there is no fixed interest charges, our degree of financial leverage will be 1. Suppose in this case we didn't have any interest. So EBT would have been 40 and 90. It would have been the same 125 percentage. So our our financial leverage would be 125 divided by 125, which is equal to 1. Now here, if there was interest, the change in EBT was 166 percentage divided by 125 percentage, which is equal to 1.33. And what is our EBIT divided by PBT? 40 divided by 30, which is also 1.33. So coming to, if there is no fixed interest charges, degree of financial leverage will be 1. Situation 2. If EBIT is greater than fixed financial charges, that means it is a positive financial leverage because we will have a positive EBT. Suppose EBT is nil. That means EBIT equals to fixed interest charges. That means the degree of financial leverage will be undefined. To analyze, can we say if a positive financial leverage means EBIT greater than fixed financial charges and EPS will change in the same direction as EBIT. If it is undefined, it is operating at a financial break-even point when EBIT is equal to interest charges and there is a case of no profit, no loss. When EBIT is greater than fixed financial charges, it means there is a negative EBT which will impact the EPS to be negative. No fixed financial cost, no financial leverage. Higher fixed financial cost, greater financial leverage. EBIT greater than financial break-even point, positive financial leverage. When EBIT is less than financial break-even point, negative financial leverage. What is financial leverage as trading on equity? When the fixed cost is relatively high in comparison to equity capital. When we are employing fixed cost fund more than our equity capital, it is said that the firm is trading on equity. Okay. Now, when we are employing fixed cost fund, then we need to compare the cost with the benefit. So, we have a return. With return on investment, we have a cost of debt as cost. So, definitely our return of investment should be greater than cost of debt. That would be an advantageous position. If it is less than the cost of debt, it would be at a disadvantage position to use the debt financing. For example, if the return on investment is 25% and cost of debt is 15%, the surplus 10% will be enjoyed by the equity shareholders, which will boost our EPS. But if the return on investment is 10% and cost of debt is 15%, 5% deficit will be borne by the equity shareholder and will reduce our EPS. So that is why the financial leverage is also called as double-edged sword. Like operating leverage, financial leverage can never be between 0 and 1. It can be 0 or less or 1 or more. Coming to combined leverage means operating leverage into financial leverage. It measures the total risk of the firm. Now, operating leverage is contribution divided by EBIT and financial leverage is EBIT divided by EBT. Cutting EBIT, we get contribution divided by EBT. So, degree of combined leverage is equal to percentage change in EPS divided by percentage change in sales. To analyze, let us analyze combined leverage. When the operating leverage is low, financial leverage is low, the firm is at a total lower risk, but it cannot enhance its EPS and cannot trade on equity. Next is high operating leverage, high financial leverage. It's a risky combination because both the leverages are high, which will make the total risk very high. High operating leverage and low financial leverage means moderate total risk but not good combination, because EBIT is low because of high operating leverage, and due to low financial leverage we cannot do trading on equity. Trading on equity will also be low. Now, low operating leverage and high financial leverage, it is a moderate total risk with best combination, because the high financial leverage will enable us to do trading on equity, and low operating leverage will balance the risk of the financial leverage. So this is with relation to operating leverage, combined leverage, financial leverage. I hope you liked this video. If you like the video, please like, share and subscribe the video. I'll be also making one more video for solving the sums on operating leverage, financial leverage and combined leverage. Thank you so much. Happy learning.